Welcome to the Opening Bell Report.
If you looked at the market leaderboards this week, you saw it. You really almost couldn't miss it.
No, it was completely unavoidable.
Right. We are talking about signing day sports, ticker symbol SGN. I mean, the numbers on the screen, frankly, didn't look real for a moment.
They didn't. It's the kind of price action that just wakes up every single algorithm on Wall Street.
Yeah.
It demands attention not just because of the magnitude of the move, but because of the sheer volume behind it.
Exactly. We saw a rip of over 62% in a single trading session.
Wild.
And if you zoom out to the weekly view, the stock actually pushed past 100% gains.
Which is staggering.
It is. And if you're a rational actor, or just someone who follows the sports tech sector even casually, you're looking at this chart and thinking, okay, did they sign the next LeBron James?
Right.
Did they somehow revolutionize college recruiting overnight? Because to the untrained eye, this just looks like a miracle turnaround for a struggling microcap company.
You would think so.
Yeah.
But the answer is a hard no.
A hard no.
Yeah. If you look under the hood at the analysis report we're going through today, this rally has absolutely nothing to do with sports.
Nothing at all.
Nothing. In fact, if we relied on traditional logic, revenue growth, product adoption, user metrics to SGN should probably be trading in the exact opposite direction.
So just to be completely clear right off the top for everyone listening, we aren't talking about a sudden fundamental boom in athletic recruitment software here.
Not even close. What we are witnessing is a fundamental identity shift. We are looking at a pivot in the truest sense of the word.
Right.
So our mission in this deep dive is to unpack why this stock is soaring, while the underlying business, the actual thing the company was built to do, is, for all intents and purposes, totally irrelevant to the price action.
Irrelevant is a strong word, but honestly, looking at the data in front of us, it fits perfectly.
It does.
We're working from a very detailed analysis report regarding SGN's recent market behavior and some specific upcoming corporate actions. So let's just start with the reality check. We have this massive gap up. The stock is breaking through major moving averages on what the report calls climax volume. But what is the actual state of the sports business?
To put it bluntly, it's on life support.
Wow.
Yeah. If we stick strictly to the source material, the analysis is incredibly stark. It actually describes the sports recruitment platform as effectively dead.
Effectively dead? I mean, that doesn't leave much room for interpretation, does it?
No, it really doesn't. The report highlights that the core business is generating minimal revenue. And perhaps more concerning for any long-term holder, it's just burning cash.
Right.
It has massive, massive losses. If you were valuing this company based on a discounted cash flow of its recruitment app, the stock chart would likely be flatlining or just heading straight toward zero.
So we have a zombie business, minimal revenue, massive losses, and yet the stock doubles in a single week.
Yep.
That is the disconnect right there. If the business is failing that badly, why is the stock soaring?
Because the market has stopped looking at the past. Investors aren't buying the recruitment app anymore.
What are they buying?
They're buying a vessel. They're pricing in a completely different future. The market is a forward-looking machine, and right now, it's pricing in a total metamorphosis.
And this brings us to the real catalyst, the headline news. SGN isn't a sports story anymore.
No.
Yeah.
It's a crypto story now.
Right.
The core reason for this massive spike is a transaction known as a three-way reverse merger.
Okay, let's pause on the structure here for a second because three-way reverse merger sounds like legal word salad to a lot of people.
It does.
We usually see standard reverse mergers, a private company buys a public shell. Why are there three entities involved in this one?
Well, it's about consolidating assets to create a much stronger entity for the public markets.
Mm-hmm.
So you have SGN, which is the public vehicle.
Okay.
Then you have the new players coming in, blockchain digital infrastructure, and one blockchain LLC.
Blockchain with the capital AI in the middle.
Mm-hmm.
Very subtle.
Very on brand for the sector, right? But the structure here is crucial. SGN is effectively acting as a publicly listed shell at this point.
Just a shell.
Exactly.
Mm-hmm.
The management essentially realized the sports business wasn't sustainable, so they finalized an exit strategy. They are merging with these two blockchain entities to pivot the entire listing into the crypto infrastructure space.
So SGN just provides the ticker symbol and the public listing, and the other two companies provide the actual assets and the new business model.
Precisely. And we have to understand the motivation here too. Like, why would SGN do this?
Right. Why give up the ship?
Because the report notes that this deal is a lifeline. Without this crypto injection, SGN was facing imminent insolvency.
They were just running out of cash.
They were running out of runway completely. So in a very real sense, the sports company had to die so the equity could survive as something else.
It's like a hermit crab finding a new shell. Except in this case, the shell SGN is the one inviting a completely new creature inside just to keep from being crushed.
That's a really vivid analogy, but it absolutely holds up.
Yeah.
And the market psychology here is just fascinating. Traders are pricing in the anticipated value of these incoming blockchain assets. They look at SGN now, and they don't see a failed high school sports app.
No.
They see a backdoor listing for a crypto infrastructure play. It is a total identity change.
And that explains the initial pop. You go from bankruptcy risk to crypto potential in a microsecond. But I really want to drill down into the mechanics of the move itself.
Sure.
Because a 62% rally in one session isn't just optimism. That is violent price action. Why did it move that fast?
This is where we have to look at market structure. It wasn't just enthusiasm or people loving the merger news. It was a textbook short squeeze.
We hear the term short squeeze thrown around constantly and, frankly, often incorrectly.
Very often.
But in this case, the setup was actually perfect for it. Walk us through the specific conditions SGN was in right before this news dropped.
To understand the squeeze, you really have to look at the positioning. Before this news broke, SGN was a highly distressed microcap stock. It was struggling, the financials were poor, so naturally, betting against it, shorting it, was a very crowded trade.
It probably seemed like free money for the bears. The company's going broke, so just short the stock and wait.
Rationally, yes, and the report highlights this perfectly. Short interest was incredibly high relative to the float. We are talking about roughly 21.9% to 26.2% of the available shares were sold short.
Over a quarter of the tradable shares were actively bet against. That is a massive overhang for any stock.
It's huge. Now, just imagine you are one of those short sellers. You've borrowed shares, you've sold them, and you're just waiting for the price to drop to pennies so you can close out and take your profit.
Right.
Then, seemingly out of nowhere, the merger news hits the wire.
The bankruptcy thesis is just instantly
dead. The company isn't going to zero anymore. It's pivoting to a hot sector. So the price starts to tick up. And this is exactly where the liquidity crisis happens.
Because all those short sellers have to exit at the exact same time.
They have to cover. To close a short position, you have to buy the stock back.
Yeah.
But because the float is small and everyone is trying to buy at once, plus you have all the retail traders piling in on the good news, there simply aren't enough sellers.
It's the classic crowded theater with a single exit scenario.
Exactly. The analysis actually uses the term rocket fuel. When those short sellers were forced to buy back shares at higher and higher prices just to stop their bleeding, they were dumping pure rocket fuel onto the fire.
Wow.
You had aggressive retail buying meeting forced institutional buying. That is what creates that vertical parabolic line on the chart you were looking at.
It's a feedback loop. The price goes up, margin calls hit, shorts are forced to buy, so the price goes up even more. It's almost mechanical.
It is mechanical. It's much less about the fundamental value of the crypto company at that exact moment and more about the plumbing of the market just breaking down for the bears.
Okay, so the stock has exploded. The shorts are squeezed. The sports company is officially becoming a crypto company.
Yes.
But let's bring this down to the listener who might be holding the stock right now, or maybe they're looking at it and thinking, do I buy here? We need to do the math on what you actually own because the ticker on the screen is still SGN.
This is the part that usually gets overlooked in all the hype, and it is the most critical part for any investor to understand. You have to look at the dilution.
Right, because if I buy a share of SGN today, I am buying a piece of the future company. But how big is that piece?
Much smaller than you might think. The report specifies the post-merger reality very clearly. Legacy SGN stockholders, meaning anyone holding the stock right now, are guaranteed to own exactly 8.5% of the new blockchain company on a fully diluted basis.
8.5%, that is precise?
And low.
It is low. It means that the current shareholders of SGN are essentially being diluted down to a very small minority slice. The vast majority, 91.5% of the new company, will be owned by the incoming owners of blockchain and One Blockchain LLC.
So let's frame this correctly for everyone. Holding SGN isn't owning the whole pie. It's securing a proportional minority slice of this new crypto infrastructure firm.
Right.
You're trading your ticket to the sports game for a ticket to the crypto convention, but you are sitting way back in the back row.
In a sense, yes. But the market is making a calculation here. It's betting that 8.5% of this new, potentially massive crypto infrastructure company is worth significantly more in market cap terms than 100% of the old, failing sports company.
That's the option value argument. You'd rather have a slice of a watermelon than 100% of a grape.
Exactly. But investors absolutely need to be aware that the share count is going to change dramatically. And the valuation metrics they see on their screen today are going to look very, very different post-merger.
Now, let's talk about the timeline. Because complex deals like this don't just close with a handshake and a quick press release. There are regulatory hurdles. When does this actually become official?
We need to circle a very specific date on the calendar. According to the analysis, the critical milestone is March 13th, 2026.
March 13th, 2026. So that's the finish line.
That is the special stockholder meeting where the blockchain merger will be officially voted on and approved. That is the ultimate binary event for this stock.
So between now and March 2026, we are basically in a sort of limbo period.
A very volatile limbo. The report is explicit on this point. Investors should expect aggressive, violent price swings leading up to this date.
And we've actually already seen a preview of that, haven't we? The analysis points out a massive after-hours drop recently.
Right. The stock gave back 14% in a single after-hours session. That is a warning shot. As the initial short squeeze momentum cools off, you're going to see a completely different class of trader enter the arena. The merger arbitragers.
Let's explain that for a second, because merger arb is a very different game than retail speculation.
Completely different. These are professionals who calculate the spread between the current price and the anticipated deal price. They lock in the exchange ratios. They trade based purely on math, not hype. So as they position themselves, and as the initial retail frenzy starts to fade, the stock is highly likely to see gap fills.
Meaning the price could drop back down to fill the empty spaces on the daily chart that were left behind by that massive vertical rally.
Exactly. It is rarely a straight line up to the merger vote. It's usually a jagged, messy path.
So if you're holding this stock for the thrill, you're certainly going to get it, but it sounds like a really bumpy ride all the way to March 2026.
Extremely bumpy. This isn't a set it and forget it blue chip stock. This is a live wire.
Speaking of blue chips, let's talk about how we should actually judge this stock right now. Usually when we do a deep dive, we look at PE ratios, earnings per share, sales growth.
You can effectively throw all of that out the window for SGN.
Literally all of it.
All of it. The analysis is very firm here. If you look at the traditional metrics, SGN looks absolutely absurd. It currently has a 58x price to sales ratio. Its earnings per share is deeply negative.
58 times sales for a money-losing company usually sounds like a disaster waiting to happen.
In a normal context, yes, it would be. But the expert view here is that those numbers are just irrelevant right now.
Why irrelevant? Just because of the pivot?
Because those numbers reflect a dead sports business. The market isn't pricing the sports business revenue anymore. It is pricing the merger probability. The report explicitly classifies the stock's current status as a pure momentum and merger arbitrage play.
That is a really key classification. It means the price isn't moving because they suddenly sold more software subscriptions. It's moving because of deal mechanics and crowd psychology.
Correct. It's a tether. The report emphasizes that this is a high-risk, high-reward vehicle tethered entirely to the success of the crypto transition.
Got it.
If you are holding SGN today, you are betting that the merger closes, that the vote on March 13, 2026 passes, and that the new blockchain company succeeds. You are not betting on signing day sports anymore.
It really highlights how incredibly fast the narrative can shift in the public markets. One day you are analyzing high school recruitment stats, and the very next day you are looking at blockchain infrastructure.
And that is the exact nature of the microcap market. It's highly fluid. These corporate shells have value simply because they are already listed on a major exchange. It's a vehicle for a private company to get public fast, completely avoiding the 18-month headache of a traditional IPO.
That's a great point. The real product SGN sold here wasn't their software, it was their NASDAQ listing.
Exactly. Blockchain digital infrastructure needed a ticker symbol. SGN had one. In this entire transaction, the ticker symbol was likely the most valuable asset SGN actually owned. It challenges the notion of value investing in a really fundamental way.
It really does. So let's recap this wild situation for everyone. We started with a confused glance at a sports stock that was up over 100%. We dug in and found out the sports business itself is effectively dead actually insolvent.
Right.
We learned it's really a three-way reverse merger designed to turn the company into a crypto infrastructure firm. That specific news triggered a massive short squeeze because over 20% of the stock was shorted by people who were expecting an imminent bankruptcy.
And that forced buying from the squeeze provided the pure rocket fuel for the rally.
Right. And now the current shareholders are looking at a math equation where they will own exactly 8.5% of the new company, with a critical binary vote coming up in March 2026, and likely a ton of arbitrage volatility in between now and then.
This is a complex situation, without a doubt. But when you finally break down the actual mechanics, the price action makes perfect sense. It's not a mystery. It's just market physics at work.
It leaves me with a final provocative thought about the modern market, something for you all to mull over. We spend so much time analyzing cash flows and product market fit.
We do.
But in cases like SGN, are we seeing the market efficiently pricing a future asset? Or is the shell itself becoming more valuable than the business inside it simply because it offers instant liquidity?
It's the zoning permit theory. You buy a teardown house not for the house, but because the lot is zoned for a skyscraper. The market is paying for the zoning, not the leaky roof. SGN was the teardown. Blockchain is the skyscraper.
That is a fascinating way to view it. When you buy a stock, sometimes you're buying a company and sometimes you're just buying the permit. And in this case, the permit was worth a 100% gain in a single week.
and a massive headache for the short sellers who clearly didn't check the zoning laws.
Absolutely. Well, that wraps up our deep dive into the SGN pivot. It has been a perfect case study in merger arbitrage, short squeezes, and total corporate reinvention.
A strong reminder that in the markets, the only constant is change.
And volatility. Never forget the volatility. Thank you all so much for listening. Stay curious, watch your risk on these high-flying plays, and we will see you on the next deep dive.
Don't forget to like, share, and subscribe for more.